big changes could be coming to Washington. How will they translate into Wall Street and the way we invest? Let's ask Don Yacktman. He's CEO of Yacktman Asset Management. He was a Morningstar Fund Manager of the Decade nominee, and as of November the 1st, his Yacktman Fund had returned a whopping 205% over the last 10 years. He joins us from Austin, Texas this morning. Good morning to you, Don.
Good morning, Margaret.
You know, when we look at not only the new blood, but the questions before Congress, are you worried that we will see a de facto increase in tax rates with this lame duck session of Congress?
I think you hit it on the head. It seems to me that this provides both sides to kind of point their finger at each other, and yet what they really want is to raise taxes, and they do that by just not doing anything.
So walk me through the scenario, though. What are the implications going to be for, you know, the everyday investor?
Well, let me preface that with a couple things. One is I think the Fed's policies have more impact in the short term. I think the longer term, the fiscal policy has impact relative to growth rates. We're focusing here on the election on the fiscal policy side. And the problem is that we have a country that taxes production and not consumption. And so as a result of that, with the spending we're doing, we're moving more money through Washington, which will have the effect of slowing the growth rate. Now, most people wonder, well, if it's just slightly less and things are more spread around, isn't that better? The problem is that if you slow the growth rate by 1% over a person's, say, roughly a lifetime of 72 years, that means that 72 years from now, we'll have half the standard of living we could have had. And so my concern is that we're slowing the growth rate. Every study I have seen, the more money spent by the government instead of by individuals lowers the growth rate.
Well, that then ups the stakes for what the Fed may be doing tomorrow, right? Talk to me about the implications of the size of and the timing of quantitative easing that we may see.
Well, I think on the monetary side, I think it's pretty clear that, first of all recessions are a result of an inventory problem. And in this case, it's a big problem because it's housing, and housing has a very long life to it, so that inventory takes a long time to go through the system. And what happened is that because of this, the government's policies toward housing, we ended up with a bubble, and we had people buying houses that couldn't afford them. So now you've got a problem where housing prices were inflated and need to come in line with other prices in the economy. The Fed's policy, it seems to me, is going to be to inflate other prices to get housing stabilized. Well, that's the basic policy.
We're continuing our conversation right now with Don Yacktman. He's the CEO of Yacktman Asset Management. His funds outperformed 97% of its peers over the past 5 years. Don, we left it talking about what was going to be happening with the Federal Reserve tomorrow. If we see further monetary policy easing as expected, what opportunities are presenting themselves to you?
Well, we tend to be bottom-up investors who look at things one at a time, and so what we focus on are situations. We try to project a forward rate of return and then adjust it for risk, so just like a bond buyer would buy. And in that environment, in this environment, and if you will, our foundation is built around very high-quality companies because we don't perceive that on a risk-adjusted basis, we perceive them as having the best returns. So things like PepsiCo and News Corp are our biggest holdings. But in the last 3 months, the third quarter, for instance, we found certain things that had plunged where we see high return on asset businesses that short-term are out of favor, and that's the kind of thing we see as falling in the tail of the bell curve. As example, we bought Apollo, which is University of Phoenix, H&R Block, Corning, Hewlett-Packard, examples of stocks that were out of favor, but long-term we felt they had good prospects.
Yeah, a lot of controversy around the for-profit education stocks. Why do you feel confident putting money to work there?
Well, it's just a matter of price. And in most cases, what happens is the stock market tends to overreact to situations. And in the short term, it's a weighing machine, and they're very unpopular. I mean, it's a voting machine, and they're very unpopular. In the long term, they're a weighing machine, and we just think that University of Phoenix, for instance, has the highest recovery rate on loans. They're very close to the target that the administration wants to achieve, and they're already taking steps to get those numbers higher and to adjust for the problems that exist in that business. But you know, they clearly we want to educate the population, and this is a way for them to pick up skills, and it's an efficient, if you will, business model to do that. It's a profitable business model, but in the short term there are some adjustments they're going to go through. Healthcare
is your third largest sector holding. If we do see the Republicans take the House, it could affect how Obamacare is funded. That doesn't worry you in terms of putting money to work in that sector right now?
Well, I think there are two or three things. One is because of the scare of Obamacare, the prices of a lot of healthcare stocks have come down. And so again, on a risk-adjusted forward rate of return, we think that's positive. We think that you'll end up with more demand, even though you'll have to give somewhat on the pricing. But we still have the demographics working toward an older population and the need for a lot of basic things. And I mean, whether it's Johnson & Johnson or C.R. Bard or Becton Dickinson or Medtronics or Stryker, I mean, all these companies fit into that pattern. If the funding slows down, then yeah, you may see a slight diminution in some of these areas, but most of these products are the kind that just are disposable and they're going to be needed anyway.
It's a demographic bet, bottom line there for you. Talk to me, I know you made the point that you're a bottom-up investor, but there is a concern that we could see inflation on the horizon here, fueling asset bubbles. Talk to me about the impact of inflation on margins, on that rate of return for you, and how you're adjusting. Okay.
If you want to go to the extreme and look at say the Weimar Republic back in the 20s, which is the far extreme, initially stocks tend to plunge, but then they adjust and adapt. What's key to, seems to me, is the ability to reprice the product. And the kind of businesses we own do that, and they don't have a lot of vulnerability to having enormous amounts of fixed assets or labor union problems. So I think they have the ability to adapt rather quickly to rising inflation. But that is a fear, I think, and that's why I think, you know, when I see things like we're coming back to our biggest holdings like Pepsi, which has a yield above the long-term Treasuries, I'd much rather have that, and because I think it has the adaptability to change.
Much rather have that than Treasuries?
Than long-term Treasuries. Oh,
wow.
Yes. I think bonds. Well, I think bonds are a real dangerous area. A real dangerous area.
All right, we've got to leave it there, Don. Thank you for your time today. Don Yacktman joining us there from Austin, Texas.